Dave earned his BS in cellular biology and molecular genetics from University of Maryland. Again, don't hold that against him. He received his PhD from Tufts University School of Medicine, and he also lectures on entrepreneurial finance and corporate finance at the Johns Hopkins Carey Business School. Neil Veloso. Neil's, you're last, so I shortened yours now.
That's fine.
He's the Executive Director of Technology Transfer for Johns Hopkins Tech Ventures. He recently joined our team, what was it, in February? When did you join?
May.
In May, yes, in a very tumultuous day. He came into Johns Hopkins. He has extensive experience in technology transfer and commercialization. He's spent the last 9 years of his career in a variety of roles at Cleveland Clinic Innovations in Ohio, and most recently serving as the Senior Director of Innovation Management, a role which he directed technology commercialization at the Cleveland Clinic Institute and 7 of the Cleveland Clinic Institute's Innovation Alliance partners. He has an undergraduate degree from Johns Hopkins University.
Get some props for that.
Yes, exactly. And he holds an MBA and a master's in environmental health sciences, both from Case Western Reserve University. And now Dave's going to go through.
Did you do the video?
Yeah, I think so. The video is on now. Yes.
Great. Well, good morning, everybody. Thanks for having me, and really looking forward to this discussion. What I'm going to do is just go through a couple slides, probably about 10 to 12 slides, to give us a little bit of a foundation. Then we'll have the panel discussion and open it up for Q&A. But if you have any questions while I'm going through the slides, please feel free to raise your hand. It's meant to be interactive. We all appreciate you guys coming early in the morning and finding the room, so thank you. Showing up is definitely 90% of it. And as Megan said, my background, I have a PhD background, so I'm a scientist by training, so I can kind of relate at that level. And I've also done a startup, so I've had co-founders, I've had institutional investors, the company's been acquired, so I kind of know how this plays out over the long run. So some of my advice is very practical, and we'll get to that in a moment. So very quickly, there's a couple of things I want to cover. Just starting off with some basic vocabulary. A couple terms that you might know, but again, just not bad to have a discussion, put it in the context of founders' equity. We'll talk about the problems that can arise with founders' equity. We'll talk about some real-world examples. I'll give some advice, and then we'll have our panel Q&A discussion. So what I wanted to do is start with a question. So founders' equity should be equivalent to what? Right? So this is kind of an open question. You think it should be equal to number of co-founders, right? So if I found a company by myself, I should get 100% of the founders' equity. Or if I have 2 co-founders and there's 3 of us, it should be a third, a third, a third, right? So that's an open question. Should it be equal to intellectual property considerations, right? So let's say that I'm the business guy, co-founder, but it's coming from an academic lab at Hopkins, right? What should the equity split be between somebody who's bringing the business experience versus maybe the intellectual property? Should it be equal to experience in general, right? So is this your first startup? Have you done this before? Do you have connections to investors and partners? Or should it be equal to value, right? What's the value that you bring to the company compared to your other co-founders? So we'll come back to this at the end, but these are some of the questions that I wanted to at least put the question out there and get you guys thinking about how do these all interplay. So there's not a right or wrong answer, and I think that's a common theme for this, but there's kind of ways to think about it and ways to frame the discussion in which you can kind of make sense of this. So this graphic, and I apologize because it's a little bit busy, but it does a nice job showing kind of the full spectrum of how a startup funding works. And if you start on the left, you have this baby, this child, right? This is where you're at the idea stage, right? And this is where you have founders. This is really what we're talking about, is when a company is started, how do you divvy up the equity? What's the appropriate methods to do that? And as you scale, so as you go from left to right, you're bringing in additional founding partners, you're bringing in seed investors, friends, families, fools, you're bringing in angel investors, venture capital, maybe one day you go public, which is the Empire State Building there on the right. Without getting into all the text, I think that there's a common theme, which is that you can be rich or you can be king, right? So if you want to be king, if you want to have 100% equity, very likely what will happen is over time you'll see that you own 100% of nothing, right? So in order to incentivize people to move from left to right in this, you need to be able to share some of the wealth. And we had a similar talk on this on venture valuations yesterday at our Tech Ventures retreat, and Jorge Aquino, who's our director of Tech Ventures, made a really good point, which is that you'd rather have 1% of $100 million than 100% of $0 million, right? So keep that in mind with equity. It's a long game. You're in it for the long haul, and there's ways to do things meaningfully. But what you don't want to do is say, mind my mind, it's all, we want to have all control, all equity, because you're just going to basically scare off investors, and the company's not going to grow. There's an opportunity cost there. So the sooner you can be knowledgeable about how to do this, the more successful you'll be. Okay, so I've got one very text-heavy slide on vocabulary, so we'll go through this kind of quickly, but feel free to ask questions. Equity, right? So what does equity mean? Equity is ownership interest in a company represented by shares issued to investors. Now you could say, well, investors, founders, employees, they could all kind of fall into that last word there, right? I do want to highlight the difference between common shares and preferred. Typically, founders and employees will be getting what's called common shares. This is really the lowest form of life. It gives you no rights to anything. It is the last people to ever get paid. And unfortunately, the world that we live in, this is just what founders and employees get. They get treated like, second-class citizens. Preferred shares is what the money gets. And the money is investors, right? So this is something that can mean a whole lot of things to different investors, but some investors will want to get paid first, right? So let's say that you've raised $10 million for a company, and it ends up selling for $8 million. Those investors are going to get all $8 million, and you're going to get nothing, right? Because they have preferred shares and you have common shares. So that's one, there's a liquidation preference is what that's called. It also could mean that they get paid 2 times what they invested before you get paid anything. It could mean that they get dividends before common shareholders get anything. It could also mean that they have voting rights and governance, which is a whole other topic, but important to know just that basically investors get a better form of equity than founders and employees. Debt. This is, depending on the company, could be also another instrument. So debt is typically borrowing money without giving up ownership, and often comes with strict conditions in addition to interest. So, and just so you know also in terms of who gets paid when, debt holders get paid before equity holders. So if I raise, $10 million from NEA, and then I raise $5 million from Citibank as a debt note, Citibank would get their capital back if we sell the company prior to so the debt holders get paid first, then the preferred shareholders, then the common shareholders. Okay, cap table. So a cap table is just a list of who owns what equity and debt in the company, basically. So it sort of says, what the capitalization structure is, who has what shares or profit interest, depending on if it's a corporation or an LLC. Dilution. So this is a scary word for not only employees and founders, but also for investors. Basically, dilution is a decrease in the value of securities based on the percentage of equity ownership as resulting of issuing additional securities. This is a very important topic. And this is also something that came up yesterday. There is an inherent risk, and I know we're talking about founders' equity here, but there's a risk in valuation that if you try to go in at too high of a valuation, it's going to be very difficult to raise subsequent round at a similar or higher valuation. So in other words, if I insist that my company's worth $10 million today, right, and we raise capital on that, if I don't hit milestones, show growth, if I can't defend that it's worth $20 million 2 years from now, there's a chance that you're going to be diluted when you have to go back for more additional capital. And just a side note, you will always be going back for additional capital. Don't think, oh, I just need to raise this $750K and then we're good. We're going to take it all the way to market. I'm always going to need to raise additional capital. So just bear that in mind. And then the last term is exit. So exit is a liquidation event of a corporation. Could be an IPO, it could be a trade sale, it could be a write-off, it could be an acquisition. So it kind of depends on what the market is sort of dictating is likely to happen, but basically this is when people actually get paid. I advise several privately held companies, and I'm amazed when founders think that, well, when we raise that $1 million, you know, I'll take $100,000 off the top. Like, the investors are buying the equity from you at that time. That's not what's happening. What's happening is they're investing into the company. And the last thing that they want to hear when you're discussing a term sheet is founders who are saying, yeah, let's just take out 100 grand, let's just take out 200 grand and sell some equity to these investors. Again, you're in it for the long haul, which is why it's important to get this right. But an exit is really when the company actually goes public or is acquired. Any questions on any of these terms? This is the only text-heavy slide. Everything else is pretty fluffy. Okay, great. So, problems that can arise with founders' equity. What could possibly go wrong? Understanding how to divide founders' equity, in fact, all equity in a startup can be complicated. Not all founders are equal, which is a difficult conversation to have. People have different capabilities, different titles, different roles, ownership, and responsibilities. You know, I have a picture here of a couple founders. You know, I can tell you it's you develop a very interesting relationship with your co-founders in the company. It's like in some ways it can be like a marriage, and in some ways it can be very challenging. But it's you know, if you pick the right co-founder, it could work out very well for you. So what are some real-world examples? So let's say that two friends start a company in their spare time and split the equity 50-50, right? They say, we're equal partners, let's do this. You have, you know, 100 shares, I have 100 shares. So one co-founder could join the company full-time, right? Taking no salary, you know, saying, I'm jumping in, I'm doing this. The other remains at his day job. One co-founder is developing the product, the other one is doing something else. One co-founder quits the company. This happens. One co-founder is really responsible for raising the capital, right? Putting together the slide deck, meeting with investors, actually bringing in the money. One co-founder is doing everything. One co-founder dies. All these things have happened, will continue to happen. They're all real risks. And my point is that if you split it 50-50 on day one, you've already lost. Because basically no matter what, if any of these things happen, you're out of luck. So one of my key messages here for founding equity is that it should vest. And this should probably be a term on that earlier slide. But basically vesting means that you don't get everything up front. It comes over time. And you can vest it how you see fit. It can be product development, right? So if let's say I'm developing a software platform, we've had employees who have had equity that's been tied to product development. So when you have a product that our first customer buys, you get another 1%, right? That's the type of incentives that if you put a little bit of thought in beforehand, it can pay off huge, because all of a sudden you'll see that incentives are aligned, everyone's doing their job, and it just reduces a lot of friction within a company. So vest, very, very important. Okay, so now I'm going to try one slide. So, and it's not easy to determine who's going to add value to a company at early stages. It can be very nebulous, right? So there's this great scene from Caddyshack. Let's see if this plays. I apologize if it's too loud. I haven't tested the volume, but let's give this a shot. Whoops. Let's go back. So how do you know who brings what value, right? So let's see if this will work.
Look at that. Oh, I keep score, Josh. Oh, well, how do you measure yourself with other golfers?
We can reenact it too.
Yeah, right. There's this great, I'll tell you what is happening. So,
Probably
Chevy
just-
Chase is talking in the clubhouse with the judge, Judge Smash. And, Chevy Chase is a pretty tall guy. He's like 7 feet tall, right? So the judge is like, what did you shoot today? And Chevy Chase is like, I don't keep score. He says, well, how do you compare yourself to other golfers? And without a beat, it says by height, right? So as we know, he's like 6 inches taller, right? So let's hear him say this.
Son, what did you shoot today? Oh, I don't keep score, Judge. Oh, well, how do you measure yourself with other golfers? By height.
So it's this great scene because it's sort of like, there's no way he can lose, right? So if you have a really sophisticated co-founder, he'll basically say, well, this is how I bring value to the firm, and make it sort of impossible for him. He's solidifying how he or she is going to basically justify their equity share, right? So that's kind of the point that I wanted to try to illustrate with that.
And surprisingly, everybody in this room probably knows what Caddyshack is. But you never know.
Watch the whole
how
movie, there's
things-
plenty of great startup advice. So what are some considerations, right? What should you be thinking about when you think about what specific co-founders or early employees add to a company? Experience, seniority, and role. Capital invested, what I mean by that is a co-founder actually putting money into the company, right? And by the way, this is a great way, if you're talking to investors, I mean, if you don't have skin in the game, and typically you can make the argument that you have sweat equity, right? You've been putting in a lot of time and effort. But if you can put a little bit of money in, and it doesn't have, you don't have to match a venture investment, but if you, put in $5,000, $10,000, I mean, that goes a long way building confidence with investors. Sweat equity shouldn't be ignored. Prior and ongoing experience, right? So have you done startups before? Do you know, is this your first rodeo? An IP contribution. Okay, so then just a couple slides left. Some very free advice. Don't procrastinate, right? So things will only get more complicated. Pushing this off to a later date, this discussion, not a good idea, right? As time goes on, startups move so fast, it's like every day that goes by, things will change. So have this discussion early, get it in place, and you can change it, but just have the discussion early. A handshake, unfortunately, is not good enough. I remember when my co-founder and I went to our first law firm in Boston, and we had this, the lawyer said, have you guys talked about, founders equity? And my co-founder very quickly, yes, we talked about it. And I was like, we have, really? Because, I don't think we have. So I think it's good, you really need to put this down on paper and just insist on it. The expression I like is the faintest pen is stronger than the best memory, right? So this idea that things will change, write it down, document it. Large numbers make people feel good. So what do I mean by this? So if I have 1 share and you have 1 share, it sounds pathetic. If I have 100,000 shares and you have 100,000 shares, all of a sudden I feel rich. From a company perspective, and I'm sure the lawyer can agree with this, it's something that it doesn't cost the company anything more to create a large number of shares. So when you're thinking about, sort of incentivizing people, people like to feel like, I've got 35,000 shares, and man, when this thing goes public, we're going to be rich. It's actually based on the percentage, but just large numbers just generally make people feel good. And the last piece of advice, again, vest. Worst mistake you can make is 50-50 on day one and figure the rest out. Think about this, talk with your lawyers, put it in writing. It's easy to get married, it's really hard to get divorced. I mean, it's one of these things that if you can think through it and just, have a rational approach, I think it will really pay off in the long run. And then kind of come back to this slide, right? So what should founders equity be equal to? Number of co-founders. I'm obviously biased to say probably that's not the best way to do it. IP contribution, I won't completely disregard it, but I'll come back to it in the last slide. Experience, I think, is really important. Value is probably the best answer here, but it's probably some mix of all of the above. And then the last thing, and this is especially true, that ideas are cheap and execution is everything. So what this really means is that the idea of a startup, even the intellectual property, all of this, it doesn't mean anything. It's bottled up energy, but it won't be released to its full potential unless you're able to attract the right talent and the right investors to actually make it happen. So it's worth taking the time to get this right. And just be very humble about what the stage of the company is, because there's going to be technical challenges, financial challenges, market challenges that are going to really test the company over time. So it's exciting to be at the early formation of a company, but just bear in mind when you might think that the company has a $10 million pre-money valuation, you talk with your investors and they say, look, it's more like $2 million. Don't be offended. What they know that you don't is that to get from where you are today to where you have to be to actually get to that liquidation event is like threading a needle, you know, and it's just, there's very low room for error, low margin for error, and the execution is really what the investors are investing in, right? So anyway, those are my slides. We can.
Yeah.
Any questions before we go to the panel? Or maybe that's might be the panel. Okay.
So I have, many of you sent in some questions, so I'm going to pull up that in just a second. So we can go through that first and then open up the mic. Okay. So, let's see. All right, so this question really is for Matt. Going back to the discussion about a cap table. Okay, can you explain like what you think an investor wants to see in a cap table? And what are the best practices around defining a cap table?
Sure. Am I supposed to use this?
Yeah, you probably turn it on. Maybe just one, yeah.
Does this work?
Yeah.
Perfect.
Yeah.
All right. Thank you, Megan. What does an investor want to see in a cap table? Investor wants to see basically who has equity claims on the company, and so that not only means, you know, what do the founders own in the company. So to our example of a 50-50 ownership between two founders, you expect to see the two founders on there, but also anybody else who might have an equity claim. So that may be employees who have come on, or other consultants that have been issued equity. And there may be, and I think that most investors will expect to see, at least in connection with their investment, the adoption of an equity incentive plan, which would be used to incentivize not only management but other rank and file employees. And so that would be a line item in the cap table that would not represent necessarily equity that's issued and outstanding today, but equity that's reserved for issuance for those employees and other people who would be recipients under the plan. And typically the percentage on a fully diluted basis is going to be somewhere between 10 and 15% of the fully diluted equity is going to be reserved for that option plan. You may also have warrants, which are much like options. They're securities that give people the ability to purchase equity in the future, so they're not current equity holders, but they ought to be somewhere referenced in the cap table, because as an investor, you want to know what are all the stakeholders that can possibly dilute my interest, and also if there's convertible debt, and I think we're going to talk a little bit about that. If you issue debt that's convertible into equity, again, that's something that could dilute the interest of an investor. And Megan, I forgot the second part of your question.
The second part was like best practices, which I think you've answered, and
Okay.
what to avoid, right? So I think you've answered that. I have a question for Neil. I think Dave spoke a bit about this, but how do you recommend like divvying up the founder's equity immediately or saving some for later? So if the founder owns X, can you divide that again? Like can you divide a founder's equity again?
Sure, I think, the best way to approach that, as Dave said, is do it early, get it in writing, but also create an option pool that would allow the company to grow. You can bring on new employees, you can issue the equity for other purposes, but doing this, early, having it put down on paper really sets the company for success later on. I was the 40th employee at Athersys, a Cleveland biotech company. Had some options, a $10 strike price. Now the company's trading at like $2 a share. But at the time, as that employee, that equity, that option meant everything. It exceeded. I put in far more work, I felt, than my salary warranted, because you felt part of something. You felt like you're an owner. So to your question, getting it right, having the founders set up properly, having the option pool set up, really poisons the company for growth.
I think this question, Matt, you may have the best, you might have, but although you're not an accountant, you're a lawyer. What tax implications are there for equity?
Um,
Or did you? 'Cause
I guess, you know, every stakeholder's personal tax situation is going to be different. But I think that one of the main tax considerations in starting up a business is, you know, what type of entity am I going to form? I think that is, and that there are tax decisions that, there are tax considerations that are, that you need to weigh when choosing the type of entity that you're going to form. The choice that you have to make is this going to be a disregarded entity, meaning is this going to be taxed as a partnership would? So an LLC or a partnership is actually not its own taxpayer. It actually passes along its tax attributes to the owners. And so back to the example of 50-50 owners, if you have 50-50 owners in an LLC or a partnership, and say the company generates $100 of net income the first year, $50 are allocated to founder one's personal tax return, and the other 50 go to the second founder's personal tax return. And then you can contrast that with a corporation, a C corporation, which would be its own taxpayer, and would have its own corporate tax return, and paying tax on that, using the example of $100 of income, paying maybe $15 to $20 of income each year, and then the members, the stockholders of that corporation are not taxed until distributions are made. And so, although when those distributions are made, if you work the math, it's actually a double tax regime. And so, on a net tax basis, a C corp is going to be you end up paying more to the government. So you'd say, well, why do people even use C corps? Why aren't we all forming LLCs? And it's a good question. And I guess if you know that you're going to form a company that will never take venture investment, then maybe an LLC or partnership is for you. But I think everybody in this room is probably here thinking that you probably will need that institutional money at some point, and investors typically will want a C corp to invest in for various reasons, but it's really kind of a check-the-box thing for them. And typically they're going to look for that to be a Delaware corporation, although we have some corporations that, and technology spin-outs that I represent that are Maryland entities as well. So, and it's not, if you decide to be an LLC at the outset, it's not an election that you've made and you're bound to forever. You can convert to a C corp in connection with investment, and we've done that on numerous occasions just this year with companies that have taken A and B round financing. So to me, that's the biggest tax consideration that you want to think about. I think on just back to the discussion of the options. Options are, and Neil and Dave, I guess you probably, you know, based on your experience in either being recipients or having issued these are incentives that employees typically don't exercise until there's that exit event. And that's fine, although on for the employee's perspective, it actually behooves them to exercise at some point in advance of the eventual sale. We're getting to the weeds a little bit here, but basically you have to hold a security for at least a year before realizing before that exit occurs in order to get capital gains interest rate, capital gains tax treatment, which is much more favorable than ordinary income rates. But typically what happens is the option pool, the option employees on exit will just receive payments in exchange for their options at the closing of the transaction, and they'll all be taxed at ordinary income rates. Hopefully it's a really large number, so the net number they're happy with as well, but it's from the employee's perspective, that's one tax consideration they have.
Yeah. Actually, just one more thing on this. There's one more really important thing I think should be mentioned, which is what's called an 83B tax election. It's kind of a fancy term, but basically what it means is that when you get an option from a company, and again, I'm not an accountant, so you have to speak to proper counsel on this, but you can basically pay for the taxes now, right? But you have to sort of prove what that's worth. But if you basically hire an outside firm to do an evaluation of your company, and they do this valuation, they say, right now this company's worth $1 million, and let's say you have 10%. if you pay the tax on the 10% now, you don't have to pay for the future. And the catch is you have to do the 83B within either 30 or 60 days of when you get the option. But if you really, if you can afford it, right? So, I mean, paying tax on $100,000 is not, not cheap. But if you can afford it, it might be great, because 10 years from now, if that company's worth $100 million, you've basically paid 1/10 of the tax.
Roth IRA almost.
That's right. So it's something that you should at least know about. Again, it sort of depends what the valuation is, whether you can afford it, and if you're in that time window, and if you sort of qualify for it. But an 83B, in addition to what Matt said about being an S corp or C corp or LLC, is from a founder's perspective or an employee perspective, really important to bear in mind.
Can I ask a question about that?
Yeah.
Do you mind?
No, go ahead, please.
Okay, so I just looked at this with our accountant through SC&H, Beth Bareham, if anybody, she's awesome. She also made a comment about that 83B,
Yep.
that it's at vesting, correct?
Well,
Please.
again, I'm not an accountant, but I think I can answer this one. So the reason you file an 83B is you may, if you're a recipient of an equity incentive that, and it may be an option, but more often it is actual equity that you receive that vests over time. And so on the date, say that the stock is worth $10 on the date of the grant, well, you'd happily pay that tax. Maybe it's $50, depending on what your tax rate situation is. But those shares vest over, say, 3 years. And in that third year, the company's just gone gangbusters, and the vesting basically would put the value of those shares, that third tranche of shares, at the $100,000. The date that it vests, you're deemed to have been granted those shares at the higher value. And so if you file an effective 83B, you've paid your $10, and as they vest, there is no taxable event. And so, it's you've gotten some good advice on that.
This question is for Neil. I bet there's probably some people in this room that are also interested in this. Can you discuss the difference from an equity standpoint of scientific advisors versus board members?
Sure. I think at a couple layers, being our Hopkins hat on, there are certain conflict of interest rules within the university that would govern the ability of an inventor who's a Hopkins employee, a faculty member, etc., to serve as a board member for a company, where you are, really taking on sort of governance of that entity versus taking on a scientific advisory role with the company. I believe the threshold now is once the company has received investment of $20 million or above, faculty entrepreneurs cannot sit on the board anymore. They must go on to they can go on to the scientific advisory board. In both cases, there is some ability to get compensation for your roles. Generally, that's in the form of equity